All right, everyone. Bismillahirrahmanirrahim. Assalamu alaikum. My name is Yasir Yamin, and I welcome you all in this session. Guys, in today's session, we'll be doing some practice questions which are from ACCA's Study Hub. And the area which I am focusing in today's session is predominantly two accounting standards, which is one IAS 40 and the other one is IAS 36, Impairment of Assets. Now, these are practice questions of Study Hub, which I have replicated into my notes. All right. But we are not doing all available practice questions that they are there. I've selected a few practice questions that I feel, from a conceptual point of view, they are more prone to mistakes. And that is why I've selected some of the questions. We are going to discuss these questions, solve these questions as we move forward. And I would like you to pay very close attention while we do these questions. All right. And I'll take your questions as we move forward. So let's begin. We'll start with the questions which pertain to IAS 40 first. All right. So question number one for today's session. Which of the following is an investment property under IAS 40 investment property? Which of the following is investment property under IAS 40? Now you have four options A, B, C, and D. D is owner occupied property. Can an owner occupied property be investment property? You need to answer Y or N. No. Very good. Property that is available for sale in the ordinary course of business. No. IAS 2. Property under construction on behalf of third parties. No. It's a construction contract, right? If you're constructing something on behalf of third parties, you are going to sell your services to them, then it is the concept of revenue. It has nothing to do with it being your asset because you're constructing for another party. You're not constructing for your own self, right? Then a building that is vacant but held to be rented to third parties. Yes. A building which is vacant and held to be rented to third parties. Any property which is held for the purpose of capital appreciation or rental purpose, it is supposed to be your investment property. Done. Point number two. Under IAS 40 investment property, which of the following transfers could result in a change from a cost model to fair value model? They are saying, referring to IAS 40, which of the following, there are three possible cases, which of the following could result from a shift from cost model to fair value model? So you are going to shift from cost model to fair value model in which of the following circumstances? Number one, a transfer from investment property to owner occupied property. If you have a transfer from investment property, which is carried under IAS 40, to owner occupied property, which is carried under IAS 16, what are the possible cases? You need to assess if this criteria is met or not. All right. So just imagine what could be the case when you're transferring from IAS 40 to IAS 16. Under IAS 40, guys, under IAS 40, there are two possible models, which is cost model and fair value model. Then under IAS 16, there are two models again. One is cost model and the other one is revaluation model. I ask you a question. Can a shift from IAS 40 to IAS 16 can possibly result in a shift from cost model to fair value model? Is that possible? Give me your idea, yes or no? Somebody is saying no. Why? Let's think about it, guys. Obviously, we need to shift from this model to fair value model. So first, cost model is possible under IAS 40. So this part is okay. But we need to shift from cost model to a possible fair value model. But in this particular case, we are shifting to IAS 16, and under IAS 16, there is no such things as fair value model. And if there is no such things as fair value model, this particular scenario is not possible in case number one. You have revaluation model under IAS 16, but that revaluation model is not fair value model. So this technique or this outcome cannot be promised under circumstance number one. Let's talk about circumstance number 2. A transfer from inventories to property available for rental. So you had a property which was held as an inventory to be sold on to another customer, but later on you decided that you are not going to sell that property entirely to a customer, rather you are going to rent it out. So you are technically shifting from IAS 2 to IAS 40. Now, under IAS 2, there are two models. One is cost model or CM, and the other is NRV. And when you go to IAS 40, there are two possible models, cost model and fair value model. I ask you, is it possible that we shift from IAS 2 to IAS 40 and a scenario comes where we are changing our accounting model from cost model to fair value model? Is it possible under this scenario? Two scenario. Give me a Y or an N or a no. N. Very good. It is possible. Excellent. Let's try out the third one. A transfer from investment property to inventories when the property is intended for sale. Vice versa of this. The third scenario is the vice versa of this. So technically, you are shifting from IAS 40 to IAS 2. You have cost model under IAS 40, but do you have any fair value model under IAS 2? The answer is no. The answer is no, no, no. So this is also not possible. So what should be your answer? One only, two only, one and two, one, two and three. What should be your answer? Your answer should be B. Does everybody understand this? This was a conceptual thing, right? So let me know. Is it clear to everyone? Give me an okay. Very good. Excellent, guys. You guys are very smart, mashallah. Let's move forward. Okay. Question number 3. It says Barlow Company owns a property which it rents to third parties and do not occupy itself. That means this property is basically investment property. You rent it out to other people and do not occupy yourself. Examiner says it acquired the property on 1st January X5 for $10 million. At 31st December X5, the fair value is estimated to be $10.6 million with expected selling cost of 0.2 million. Expected selling cost of 0.2 million. Now, you have a property which costed you 10 million, right? It has a fair value and the fair value is 10.6 million. Technically speaking, since the time you have bought it, there is a fair value gain of 0.6 million if you carry this investment property under fair value model. If you carry this property under cost model, which is allowed under IAS 40, then normal depreciation rules apply. But remember, if it is carried under fair value model, then there is no depreciation. No depreciation. Okay. Examiner says at 1st January X5, the property had an estimated useful life of 40 years. They are providing you useful life. Barlow Company uses the fair value model to measure the carrying amount of the property. Is this useful life relevant to me if we use the fair value model? Give me a yes or a no. Is this any, anyhow useful for me? No, because I'm not going to depreciate it if I'm carrying this at under fair value model. Remember, guys, under fair value model, there is no depreciation. There is no depreciation. So you only mark to market, and whatever gains or loss arises, it is recognized under P&L. Make sense? Examiner asks you what will go as a gain in your P&L, obviously, and what will be recognized in, as far as financial statements are concerned. So what amount in what statement? In what amount in what statement? So I guess it's pretty clear that you had an investment property which had $10 million. You had an investment property of $10 million. The fair value was $10.6 million. So there was a fair value gain of $0.6 million. And this $0.6 million, somebody is saying it is supposed to be recognized under OCI. So you are saying that the answer should be 600,000 As far as the amount is concerned, the gain should be 600,000. And where should it be recognized? Somebody is saying OCI. Nadia, no, not OCI. See, you had a property of $10 million. Fair value was $10.6 million. 0.6 million or 600,000 was the gain. The accounting entry should be investment property 600,000 debit, PNL 600,000 credit. So it's not OCI, it's PNL. The answer should be, you will have to select in your examination. Your answer should be statement of profit or loss and not other comprehensive income. Understood? Right? So in your examination, it will be a drop down. You will have to drop down and select this option and this particular option to make it a correct combination. Make sense? Let's move towards the next one. And next one will challenge you, by the way. For several years, Jaswinder Company has applied the cost model to its investment properties. Very good. On 1st April, from 1st April 2023, the fair value model was applied to investment properties. So historically, Jaswinder Company had been applying cost model to their investment properties. But from start of this year, your accounting year end is 31st March X5, guys. So X4. Your accounting year end is 31st March X4. That means 1st April 20X3 is the year start. So what your examiner is basically saying is that right from the year start, the fair value model was applied to investment properties. So you shifted from cost model to fair value model for the same investment property. Done. Examiner is saying as fair value was greater than carrying amounts across all investment properties, a fair value gain of $30 million was recognized in the financial statements. Can anybody tell me what would have been the accounting entry for recognizing this $30 million fair value gain? What would have been the accounting entry? I just told you, by the way, a while ago. I just want you to repeat it. Can anybody tell me what would be the accounting entry to recognize this $30 million gain? Absolutely correct. Investment property debit 30 million and profit or loss account credit 30 million, right? So remember, $30 million gain will go into your P&L. Okay, very good. There has been no change in the useful life of investment properties, but under fair value model, any change in life or no change in life is irrelevant to us. Examiner asks you, what effect will this change in accounting policy have on the financial statement for the year ended 31st March X4? Now you have shifted from cost model to fair value model. And after this shift, you have a fair value gain in your P&L. So they are asking you what will be the effect of this change. You have four options, A, B, C, and D, right? D. The first option is both operating profit margin and gearing will increase. Let me ask you this. Will operating profit margin increase due to this effect? Give me a yes or a no. When you recognize a fair value gain in your P&L, obviously your OP margin, your operating profit margin will increase. So technically speaking, your operating profit margin will increase by 30 million, correct? If your operating profit margin will increase by 30 million, then technically your profit after tax will also increase by 30 million as a result of this fair value gain. And as a result of this, technically your retained earnings or your equity will also increase by $30 million. Do you all agree? Do you all agree or not? I want an answer from everybody, guys. Do you all agree? Make sense? Now I ask you, if we increase our equity, what would it have an impact on gearing? If we increase our equity, would the gearing increase or decrease? You see, gearing means debt levels in your total capital structure. What amount of loans or what amount of long-term liabilities are there in your total capital structure? Technically speaking, in your total capital structure, if equity increases, debt as a proportion of total capital structure will fall, obviously. So gearing will decrease. Now they are saying both operating profit margin and gearing will increase. This is partially correct, but impartially incorrect as well. And partially incorrect as well. Do you all agree? So A cannot be the option. A cannot be the option. Is it clear to everybody? Hmm? I hope it is. Done. Then look at the second option. Look at the second option. Other comprehensive income will increase and gearing will decrease. I ask you one question. As a result of this fair value gain, will your gearing decrease or not? Will your gearing decrease or not? Yes. So this portion is correct. But the other portion, will your other comprehensive income increase? Will your other comprehensive income increase? No, because this fair value gain is recognized in your P&L. Very good. Profit before tax will increase and gearing will decrease. Does this seem correct to you? Very good. It should be correct. We'll read the last one just for the sake of formality. Profit before tax will not change and gearing will increase. Definitely. Both are wrong points. This cannot be the option. Make sense? So is everybody clear why C is the correct answer? I hope you are. Very good. Let's move on. Let's try some other MCQs as well. And now something on impairment, guys. Right? It's not difficult, right? You guys can do it. These are just conceptual questions that are helping us understand or validate our concepts, nothing else. So examiner says Noddy has a property included in its statement of financial position at a carrying amount of 2.75 million. I'll write it down. We have a property, or Noddy rather has a property, which has a carrying value of 2.75 million. Understood. The property had been revalued during the year. If the property had not been revalued, its carrying amount would have been 1.25 million. Wow. So basically, what they are saying is that their carrying value before revaluation would have been 1.25 million, and carrying value which is carried under SOFP, which is after revaluation. So technically speaking, carrying value after revaluation is 2.75 million. Now, I am going to ask you a very difficult question and a very conceptual question. Let's see how many people can answer. What is the amount of revaluation that happened on this property? What is the amount of revaluation? Oh my God. You guys are correct. The value of the property before revaluation was 1.25. After revaluation, it was 2.75. Yes, 1.5 million would have been the revaluation on this property. The most likely accounting entry would have been, in more simpler terms, property debit and revaluation reserve credit 1.5 billion. This would have been the accounting entry, right? Examiner says following a fire. Fire. What comes into your mind when you listen the word fire? Impairment. Indicator for impairment. Following a fire, an impairment review of the property has been undertaken, and it is estimated that its recoverable amount is only 1 million. So technically speaking, you have a property which is carried in your books at 2.75 million, which is after revaluation. Now, you have a property whose recoverable amount after the event of fire is only 1 million. So technically speaking, impairment is said to arise when your carrying value exceeds your recoverable amount. So there is an impairment of 1.75 million. Can anybody tell me what should be the accounting entry to recognize this impairment of 1.75 million? I always ask students to start with the easy thing. I am asking you to make an accounting entry on impairment, right? The easiest part in all of this is that for sure your asset is going to be credited by 1.75 million. That part is pretty much clear. There is an impairment on assets. So the value of asset will fall, asset credit 1.75 million. Done. The question is, what will we debit? Now, normally we debit our P&L straight away. But remember, guys, in this case, this is a property which has been revalued previously as well. So following our traditional rules, first we need to knock off the earlier recognized revaluation reserve. Makes sense? We cannot have a gain in equity while having a loss in P&L on the same asset. It does not make sense, right? So we need to reverse our previous revaluation reserve first. This is kind of a devaluation on property, right? So 1.5 million revaluation reserve will be reversed. This is a reversal, right? And then the balance goes into P&L as per normal principles. Agreed, everyone? Is it clear to everyone? Now, your examiner asked you how much of the impairment should be recognized in the other comprehensive income in accordance with IAS 36 impairment of assets. How much? How much will be recognized under OCI? Is it clear to everyone? The answer should be 1.5. Done, dusted? I hope it is clear. Very good. Let's move towards the last question of tonight. In 20x3, Angry revalued a 360,000 plot of land which had been purchased in X1 for 300,000. So you had a plot of land which was earlier purchased for 300,000. You revalued it to 360,000 and hence you recognized a revaluation gain of 60,000. What would have been the accounting entry? Land debit 60,000, guys. Revaluation reserve through OCI credit 60,000. Okay, done. Examiner says in 20x4, Angry revalued 230,000. A second plot of land which had been purchased for $100,000 in X2 and recognized a further revaluation gain of 30,000. Remember, guys, this land is separate and this land is separate. Both are separate lands. Both are separate lands. On this, you would have recognized an accounting entry land 30,000 debit, revaluation reserve 30,000 credit. Understood? Is it clear to everyone up till now? Let me know, guys. Is it clear to everyone up till now? Very good. Let's move forward. In X5, Angry wishes to write down the carrying amount of the first plot of land. Please note, Angry wishes to write down the carrying amount of the first plot of land from 360,000 to 260,000 because of an impairment loss due to changes in market prices. So basically on the first plot of land, you want to recognize $100,000 worth of impairment. Now remember, the land which you are on which you are trying to recognize $100,000 loss already had a revaluation reserve of $60,000. So what should be the accounting entry, guys? Very good. Excellent. Land definitely would be credited by 100K. That's for sure. First, you will reverse the revaluation reserve, which was earlier created of 60,000. And then the balance will be recognized in your P&L 40K. I hope it is clear. Done. Examiner is asking you match the amounts to be recognized in P&L and OCI for X5 for the impairment loss. So in P&L, this will be 40,000 and in other comprehensive income, it will be 60,000. Is it clear? Is it clear to everyone? Acha, give me your feedback. Do you feel that the questions, the selection of questions, and the way we approached these questions did give you some validation of whatever you have learned? Did this help you? Okay, these are small mistakes that you do while solving your final accounts questions, or these are small mistakes that you can do while solving your real examination. You just simple things that you might miss out. All right. So these type of questions actually help you in clarifying the concepts, right? So I hope everything's good.